Hey everybody, appreciate you taking out some time to join me here tonight. I'm going to give it a few more minutes, let some more people join. Um, I appreciate you making the time to come hang out with me for a little bit. So all good stuff. Tonight we're going to get into unsecured lines of credit for real estate investors. Discuss current climate of the market. Try and give you guys some really good value around what's still available to us in the marketplace. So, just going to give it a couple more minutes. We'll go through some slides. Any questions anybody has, please feel free to just shoot them at us. As we get closer to the end here, I want to take out a couple and make sure I'm answering all your questions. So I'm just going to give it a few more minutes here, and then we'll get rocking and rolling. Like I said, just to give it another minute or two, let people get on. We got a few people on Facebook, a few people on YouTube. Again, any questions that you guys are going to have as we go through this, just shoot them at me. I'm happy to answer anything that you have, as well as making sure that we're going over some options here to potentially get you access to some capital and take advantage of some opportunities out there. Below is our contact information. So, mark it down. You want to get a hold of us. That'll be scrolling throughout the night. And I'm going to kind of just start to dive into some things here now as we start to move forward. So, thank you for joining, me tonight. Like I said, my name is Nick DiFederico from MB Capital Solutions. Tonight, we're just going to, go over some current options, changes in the marketplace, for clients, for investors, for business owners, for people who work with us. We're getting a lot of calls. Are we still lending? Are we still being able to get, access to capital for clients? We are, and we're going to go through some of those options tonight. Talk about some of the situations that we're seeing clients run into. Obviously with everything going on currently and in the country with, coronavirus, with COVID, with, being quarantined, locked in, stay at home orders, things have come to a little bit of a halt. So we're definitely want to make sure that we're giving good value, good understanding of, options that most people don't realize may be in the marketplace so that we can build up capital and still be able to take advantage of opportunities. A lot of the clients that I'm talking to right now, the game plan is to just kind of position themselves so that when we all come out of the house, that we're able to take advantage of opportunities. I personally believe that once the stay-at-home orders are lifted, the people that have positioned themselves the best, with liquidity, with access to capital, with access to funds, are going to be able to take advantage of a ton of opportunity in the marketplace. So if you're one of those investors, if you're one of those business owners who haven't done so, now's the perfect time to start kind of putting your ducks in a row. Use this time to set yourself up the right way. So we're going to go through some options on the unsecured side, answer any questions that anybody may have. So, whether you're watching this live now, and I thank you for being here, or if you're watching it, later on, or if you send it out through an email, we do appreciate you taking time. If you do have answers while you're watching it later, feel free to shoot us an email there below our contact information. We want to make sure that we're answering anything that anybody may have. So give it one more minute here, and then we're going to kind of dive into some slides, go over some stuff, and kind of make sure that we're not spending our entire night together. So as we start to talk about, options here, one of the things I want to do before we get into it is really, just kind of go into who MB Capital is. MB Capital, my partner Eric Moss started in 2009. He was a real estate investor that learned, a couple of new interesting ways to be able to fund his deals. So, he acquired, a good amount of capital through lines of credit and started to use it in his real estate investing business. And then he set out to, teach others exactly what he learned. So we're located in South Jersey, in Sewell, New Jersey, just outside Philadelphia. And what we specialize in is helping small business owners, real estate investors get access to opportunity money, working capital, lines of credit in the business name that we could use for any general working capital purpose. So use it for down payment money, use it for gap funding, for small business owners, use it for marketing materials. There's no restrictions on the use of the funds. So it's a perfect tool to be able to get in and out of deals, and more importantly, have permanent funding to be able to use and leverage over and over again. We are a national company. We work nationwide. There's not a day that doesn't go by where, me or a member of my team aren't talking to a real estate investor, business owner somewhere in the country. So we cover coast to coast, being able to build up capital. So, we talk to a lot of different types of clients, work with a lot of different types of individuals. At the end of the day, we've helped over 1,700 clients obtain over 60 million in unsecured funding. And we'll go into a little bit more about the specifics of unsecured funding here in a second. But in working with MB Capital Solutions, our ultimate goal is to position you and your business for long-term success. We've learned that you need capital in order to do so. So we appreciate working with clients that understand what we do and who are out there active. So So again, as I was mentioning, what is an unsecured business line of credit? So when you're going unsecured, essentially what you're doing is you're leveraging the strength of your personal credit file to get you access to funding inside the business name. So these are revolving lines of credit that are backed by your personal guarantee, but they don't require collateral. So we're not collateralizing any asset. We're not collateralizing a property. We're not collateralizing, land, title of anything. It's all based off of the personal strength of your credit file. Funds are issued inside the business name, and you're just personally guaranteeing. A business line of credit is issued by local, regional, national lenders. Excuse me. We work with lenders nationwide, like I mentioned. So the ability to put in place lines of credit for clients, no matter where they're located, like I said, to be able to use for any general working capital purpose. Since they are being personally guaranteed, lenders are basing their decision off of the strength of your personal credit. So when we're working with clients, we're really looking at, more importantly, your credit data versus just your overall credit score, so that we can position you the right way to be able to get you access to capital. Now, in working with us, when we're working with lenders nationwide, the key to what we do is we monitor the lender's trends. So how are they approving clients? What credit bureau are they looking at? What type of limits are they giving, so that we could strategically acquire you enough funds to be able to get whatever deal or opportunity you may have accomplished. For our real estate investors, what are they using the money for, the lines of credit for? So typical real estate investor is using it for gap funding. That skin in the game money. You may be using hard money or conventional financing to get into a deal, but you still need that 5, 10, 15, 20% down payment. That's where the line of credit comes into play. Now, based on current situations, I know a lot of hard money lenders are requiring more skin in the game. So you're going to need to have more down payment money. You're going to need to have reserves. You're going to need to have holding costs already acquired before you get into a deal. So that's why when I say clients need to be starting to position themselves with more liquidity, more funding, more access, the real reason is because the marketplace is changing here moving forward. So if you're currently using hard money, then that's awesome. You're now going to be required to put more skin into the game. So the more funds we can build up, the more access you have, the more you're going to have to be able to put down into a deal, show your hard money lender that you have reserves, that you have 6 months worth of payments sitting there on a line of credit that you can access to be able to facilitate your deal. So the down payment money, rehab money, I tell a lot of clients, especially if they're using hard money, but you have access to a line of credit, leverage the line of credit. It's cheaper interest, but then it's just more fluid in the flow of the deal. So it'll keep your deal moving. It'll keep your contractors on site. You'll have to spend less time waiting for an inspection from your hard money company to come out and issue you a draw. You don't have to, hit any roadblocks in terms of keeping your contractors moving. Front the project through the line of credit, and then just take one draw at the end and be able to pay it back. 100% finance a deal. Depending on the market you're in, if we're able to get you somewhere between $50,000 to $150,000 in lines of credit, you're going to be able to 100% fund a deal. I personally invest in the Philly market, and typically purchase prices are anywhere from 50 to 100,000, and then another 50 in rehab. So depending on how you're positioned with the age of your business and how you're positioned with your personal credit, we can potentially get you enough funds to be able to 100% finance a deal, and it's just going to be more cost effective than using private money or hard money when you're getting into these opportunities. Holding cost, especially right now. A lot of clients right now, we're getting them access to funds. They have a property on the market. With the way the market is right now, yes, properties are still moving, but a lot of clients, they're just the days on market are going longer than they anticipated. So they're being able to leverage the line of credit just to cover holding costs. Make sure that they can weather the storm until the property does get sold and funds come back. Emergency funds. Coronavirus is the number one example I'm going to give moving forward when people ask about emergency funds. I've for years now have talked about just having access to capital for when things go wrong. And everybody asks, well, what could go wrong? My typical answer would be, you go over on budget, or the house doesn't sell. Well, what if a pandemic hits and now all of a sudden local ordinances shut everything down, and now you need access to capital, not only for your business, but for you personally as well. So having access to lines of credit are just going to help you, kind of weather any type of emergency, whether it's a pandemic, whether it's something personal. Moving forward, as I keep saying, those that are sitting with capital are going to be able to take advantage of the most opportunities. So now's the time to be able to build up access, get liquid, have access for when an emergency does hit. And then overall working capital. We need working capital to operate as a business. So whether it's marketing costs, payroll, health insurance, we just need access to additional funds. So, these are the typical uses real estate investors are using the lines of credit for, to be able to get in and out of deals and, just keep their business moving forward on a daily basis. Building business credit versus building access to cash inside your business. I talk a lot about this. There's a big misconception with business credit that you need to start by building up your D&B score and building up a Paydex file, where if you have good personal credit, we're going to be able to get you access to funding. So that's why I always talk about building business credit versus building access to cash. Having a store credit card is great. Having a net 30, 60, 90 day account is great. The problem with that is you can't go purchase a property with it. Like, you can't use your Best Buy or your Shell or your Amazon 30-day account to go purchase a piece of real estate. So that's why I educate on building up access to cash inside your business, because more times than not, it's more important to have cash inside the business than it is just to have a good D&B score. So a lot of the net 30, 60, 90-day accounts, we don't implement those. The store credit cards, we don't implement those. We focus more on cash access to be able to help facilitate our deals. So what type of products are out there when we're going unsecured? And I'm going to go over some of these key points and then talk about how some of these things are already starting to change here in the current marketplace. So your traditional lines of credit, these are more for the business owner and for those that have a well-established business, 2+ years in business. They have documented revenue, 350 plus. They have the tax returns. They're good on paper. 2 to 3 years of personal and business tax returns. They're showing good income. They're showing good revenue. Typically, what we're seeing is a 30 to 120 day underwriting process. With this traditional checkbook line of credit. And typically what you're going to get approved for is, 15% of the revenue. If we have $1 million in revenue, we have good tax returns, we have good personal credit, we're going to be able to get a line of credit in that $150,000 range. Typical interest rates on a traditional line of credit, prime plus 0 to 4. Prime interest rate right now is at 3.25. So, we have a couple lenders right now that, they're doing prime plus 0 promotions. So, if you can get access to $150,000 at prime plus 0% right now, you're talking about 3.25% interest only payments while you're using the funds. So if you've positioned yourself in such a way where we have a nice business, it has, age, it has the financials to back it up, there are some really good products out there, even in this current environment, that we can take advantage of. So, typically, like I said, we need to see, good personal credit, 2 years in business. And typically it's not going to be a real estate investor. Unfortunately, a lot of real estate investors and a lot of real estate, brokerages and anybody involved in real estate business is looked at as high risk. So even though you may be a real estate investor and have all those things, it's not a slam dunk to acquire that type of product. We have to get a little bit more strategic when we're dealing with a real estate investor. So a normal business owner, it may be a pediatrician, it may be a plumber or contractor. If you're well documented, there's still definitely, options in this marketplace for us to be able to get you a traditional line of credit. Now, there's a difference between the traditional line of credit and the streamlined line of credit. With a streamlined line of credit, basically what the lenders are looking for that implement that type of product are 2 years in business and good personal credit. So if we have, a 680 plus score where our data points are in the right position, we have an entity that's set up for 2 years old, 2 years, we can get access to capital. It may not be 10% of your revenue. We might not be able to get $150,000, $200,000 on one individual line, but what we're able to get is somewhere between $25,000 to $100,000 on an individual line, just based off of the strength of a personal credit file and the age of the business. We won't need financial docs. We won't need, tax returns. And I say that with a little bit of an asterisk there because, I believe that things moving forward will change. I think we may need to see a little bit more documentation with our lenders. But the good thing is, even with a streamlined line of credit, we're going to be able to get that real estate investor who may not have full docs access to capital. And like I said, in working with us, where we can get strategic is being able to acquire multiple of those types of products. So to give you an example, client, a couple of weeks ago before the pandemic hit, we were able to get them 4 separate lines of credit, 3 for $50,000 a piece, and then a 4th one for $100,000. So almost $250,000 in about 30 days time. So, we can acquire multiple products to be able to build up the access. We want to do that over the course of time anyway. In the current marketplace, I think we're going to see a lot more of the traditional line of credit overtaking the streamlined line of credit. We're going to need to see better qualified borrowers. We're going to need to see a little bit more paper. And that's where working with us is going to come into key. Since we know the trends of the lenders, since we already know how they're approving clients, if we're able to work with you, put you in the right position to be able to maximize, how you're positioned to be able to get access to capital, you're going to do much better on the back end, as opposed to trying to do it yourself or just kind of floating from bank to bank. So, traditional lines of credit, streamlined lines of credit, 2 really good options. For the real estate investor, going to be leaned a little bit more to the streamlined line of credit because it doesn't require as much documentation, and lenders are a little bit more, willing to work with you, as opposed to the traditional line of credit where that's more the straight business with good tax returns and not a high risk industry. One of the things that you'll see the difference there is the UCC filings. So UCC filings are, think of it as like a lien on a piece of property. So you go to a bank and they put a UCC filing on it. They're now in first position so that if anything happens, they're going to get paid back first when they have a UCC filing on it. Typically, what a UCC filing does, however, is it kind of halts any type of line of credit that you get after it. Because once a lender sees that there's another lender with a UCC filing on it, It's kind of like, a mortgage lender wanting to be in second position. Most don't. So that's why we'll get strategic, especially with the streamlined line of credit, where most lenders are not putting a UCC filing on it, depending on the exact lender. It allows us to get strategic in acquiring multiple lines of credit before going to a lender who may put a UCC filing on. So good options there. Checkbook locks, both are checkbook locks. You can use it for any general working capital purpose, like I mentioned. So use it for down payment money, use it for rehab funds, use it for the holding cost, use it for emergency funds. No restrictions on the use of the deals, use of the funds, but most importantly, access to the funds when needed. Credit cards. So we've been seeing a lot of clients right now, leveraging and getting access to credit cards. We're doing a lot of 0% credit card plans, especially for real estate investors that need capital. With the COVID situation and coronavirus situation, a lot of different things have popped up, especially for real estate investors. They may have been going into a deal where their hard money lender was giving them, a lot of leverage, 90% on the purchase, 100% on the rehab. And before they could close, that kind of changed. So now they need to bring more money to the closing table. They need to show reserves, and we're kind of helping position a lot of clients through the credit card model. So the credit card model is still flowing very well. A client in the past week, we got them $80,000 within 7 days of starting our application process. And a lot of clients were getting 0% credit cards, not just for the typical uses of a credit card, right? Most people think, oh, credit card, I can just swipe and that's about it. But what we do is we show our clients, 3 to 5 different strategies to actually be able to liquidate a credit card into cash and be able to put it into our bank account and use it as working capital, as well as setting them up with a third-party company that when they have a property under contract, what this third-party company actually does is take funds directly off of the credit cards and can wire it to the title company. So if you have a property under contract, you have an agreement of sale, you need that 10-20% down payment sitting at the title company, and you have cash sitting to be able to show for reserves. A lot of clients right now are actually taking the credit cards and having the funds wired directly off of the credit cards to the title company for closing. And what's really great about that model is it could be a newer and existing business. It could be a business that's literally a couple days old or 20, 30 years old. And we don't need financial docs, we don't need collateral. So it's a really good way to get access to capital if we have good credit, but may not have all the other documents that we need to get into a more traditional type of line of credit. And with a lot of lenders right now, with the traditional line of credit and streamlined line of credit sort of being on hold, because a lot of the lenders have moved underwriters to handling the PPP loan, to handling mortgage deferrals and forbearances. The credit cards are still flowing faster than the traditional lines of credit. And really the benefit to the credit card model is, not just access to capital when we need it, but really it's the 0% introductory rates. So currently what we're seeing is, anywhere from 6 to 18 months, and there's a couple lenders that are bumping that up a little bit, at 0% interest. So one of the key things about, the 0% introductory rate is from a cash flow perspective, your minimum monthly payment is 1% of the balance. So think about using $50,000, $60,000, $75,000 as your down payment gap funding on a deal. Your debt service on that is only going to be 1% of the balance. So if you pull 50 grand off of a credit card, your minimum monthly payment on that is only $500. So recently, I personally took a 0% offer on one of my credit cards that I've had for, I would say, about 10 years now, and liquidated $25,000 into cash just to put it in the bank account just to have in case anything were to go wrong. My minimum monthly payment on that is $250. I'm making that $250 payment right out of a checking account that I put the 25 grand into. If I don't use it in the next 12 months, and I have no intention on using it, it's just there for emergency, I'll pay the line back down to zero, have paid no interest on the money. And what's going to happen is, much how we coach our clients how to be able to use the initial, more importantly, it's the future 0% offers. because I've paid that line, that credit card down before the 0% offer had expired, it's going to trigger the credit card company to give me another 0% offer to be able to use. And credit card companies do that really for two different reasons. One, they're a credit card company, so they want to make sure that you're using their funds and it looks good on their balance sheet when they're carrying their debt. So the real reason to use 0% promotions on their thinking is because it will look good, and at some point they'll be able to get their 0% promotion ended and start collecting interest on it. The real reason is they know that the statistics show that almost 90% of people that use 0% promotions at some point will screw it up. So they figure if this person uses it right the first time, if we send it to them the second time, they're not going to be able to use it the second time. And we coach our clients on how to be able to use it time and time again, so that you can keep getting those 0% promotions coming from you, and you can keep using the same 0% credit cards on your deals over and over again. So the credit card model is a great model right now, especially given the climate, to help a lot of real estate investors, get into deals, finish up deals, and then for business owners as well, just to kind of weather the storm, be able to use it for payroll, use it for healthcare, use it for rent. More importantly, carry that leverage and that debt at 0%, while they're holding the money, so that it, from a cash flow perspective, it's not too draining on them cash flow wise, but more importantly, to have the access. So, the good thing about what's going on currently is that there's still options. So everybody who's been kind of sitting, waiting, not certain if there are options out there are multiple options out there to make sure that your deals are still getting funded and that your opportunities are still getting funded, so you don't have to miss out on it. And if you're not currently taking advantage of an opportunity, I always suggest now's the best time to be able to start to get those ducks in a row, start to acquire capital, start to have it so that you can deploy it once we're allowed to come out again. There's going to be a ton of opportunity here. And the more that you have access to, the more you're going to be able to get into. Before, the investor was either leveraged with a lot of lines of credit or a lot of cash. Moving forward, you're going to need a mixture of both. So now's the best time to start to acquire the lines of credit while lenders are still lending, so that you can start to put it to use. Once, like I said, once we're able to come out of this. So block requirements. So what's required of a business line of credit? So I always say that it's more credit data driven than just credit score. Obviously, with a business line of credit, with a business credit card, we're going to need an entity set up. So the older that your entity is, the more options we're going to have. Like I mentioned, with the traditional and streamlined locks, most entities are going to need to be 2 years old. Whereas with the credit card model, as long as you have a day-old entity, we're going to be able to get you access to capital. And that's because everything comes back to personal credit. So I always say, I care more about your credit data than just your credit score. That FICO score, that 3-digit number, it can be manipulated. I can, it's a living, breathing thing. As you incur debt and make pay downs, that's going to go up and down. So what about the history and, more importantly, the data? When I say data, I mean, how old is your credit file? How many inquiries have you had in the last 6 to 12 months? Is there any derogatory information? So do we have late payments? Do we have collections? Do we have charge-offs? Any bankruptcies? What's your overall credit utilization? Typically we want to see around 30% utilization ratios. That's typically the sweet spot for lenders, to make sure that you're under that mark, so that they know that you're a good lending risk. Number of current trade lines. Most people think that you should only have 1 or 2 credit cards. And for the average person, that may be true. But if we want to build up access to business capital, lenders actually want to see that you have multiple lines of credit, that you have multiple revolving lines, multiple credit cards. It shows that you're a good risk when you can show that you can manage more than just one credit card, be responsible enough to run up a limit, and still pay it back without having any derogatory information hit our file. So let's make sure that we're using our cards, paying it back. What's our high pass balance? So all that plays into into the factors that go into approval amounts and being able to get it. But typically, if we see a 680 credit score, we have limited inquiries, we have no derogatories, and we're utilized around 30%, we're going to be able to get you access to some good capital. So pros of lines of credit. I talked about a lot of different things tonight, but opportunity money, access to capital is always the biggest one. By nature, real estate investors, business owners, entrepreneurs, we're really opportunists. So, knowing that we're opportunists, what's a real estate investor, what's an entrepreneur who's not prepared for opportunity? They're screwed. So the more opportunity money we can have, the more opportunities we can take advantage of. Separation of personal and business credit. I talk about it a lot because I know how important it is, but the ability to leverage our personal credit and get access to funds in the business is key. It allows us and gives us permission to go use that capital, knowing that it's not going to report back onto our personal credit report. So separation of personal and business for real estate investors, for entrepreneurs, for business owners, it's key. We want to make sure that the money that we're leveraging and using in our business isn't affecting us personally. As a real estate investor, I go through ebbs and flows in how much capital that I'm using. But, if I'm using $100,000, $200,000 of business lines of credit, I'm now positioned much better because not a dollar of that's going to report on my personal credit report. So it'll keep me bankable, lendable, always in a position where I'm going to be able to get access to funding or do refinance if I'm doing the BRRRR model. Separating out business and credit is a must for every entrepreneur. Protecting your assets. Not just in the general sense that we're not collateralizing anything, but then also to be able to have access to capital in case things were to go wrong. It helps you protect yourself, knowing that you have access to capital, but that also that your assets aren't at risk because it's nothing more than a personal guarantor on it. Revolving, the use of being able to leverage the line of credit over and over again. So what's great about the lines of credit is that they're all revolving, whether it's the streamlined line of credit, the traditional line of credit, credit cards, we can use it and pay it back. So for what we do as real estate investors in terms of, putting money into a deal and the funds coming back to be able to pay it back, the revolving lines are a perfect way to get in and out of deals, and not just for a one-time use, but to be able to do it over and over again on a continuous basis. Cash flow efficient. So you only have a payment on it if you're using it, and you only are paying on what it is that you're using. So if you have a $100,000 line of credit and we're not using it, we don't have a monthly payment. If we're only using $25,000 of the 100 grand, we're only paying on the 25,000, not the full 100. So it's very cash flow efficient, especially if we're doing 0% credit cards. Our minimum monthly payment is going to be 1% of the balance. So it could allow us to get out there and do even more deals, knowing that from a debt service perspective, it's not going to kill our cash flow. Underwriting is not based on the business credit profile, and that's where I was going back to building business credit versus building access to cash. As long as we have good personal credit, we're going to be able to get you access to cash. So, a lot of people that spend a year, 2 years building up their D&B file, their business credit profile, to be able to go get the lines of credit that we're getting on day one. Not that it's not worthwhile, but it's just not efficient. So, underwriting is going to be based off of your personal credit and not your business credit profile. Diversification between multiple banks. And that comes into play as we start to build up more and more lines of credit. You don't want to have all your eggs in one basket, so to speak. So having, lines of credit with multiple lenders, it gives you the freedom to not have to worry. I was talking with a client yesterday where they banked with one lender. They had one line of credit with one lender. They have their mortgage through one lender. They do all their banking through one person. And then COVID hit and their line of credit got cut. And now they don't have access to almost $75,000, where we could have built up access. And if that line of credit was cut, you'd still have access to other, avenues of funding. So we want to make sure that we're diversifying between the banks that we're using, so that you're protecting yourself. Every business owner does not need to be on the application. So depending on how your entity is broken up and how you're positioned in terms of your business, every owner doesn't actually have to be on the application, especially with the credit card model. The credit card model, we could also use partners who may not even be on the entity, so they just are more of a credit partner. So there's ways for us to get strategic. If you have partners in your company, one of you may not have the best credit, but one of you may, we're still going to have options for you. Underwriting is normally 2 to 4 weeks. I say that right now with more of the traditional lines of credit, things are definitely taking a little bit longer. We are getting some approvals, but things are definitely at a lag. With credit card funding, we're starting to see a little bit of a lag as well, but things are still moving. So typical is normally 2 to 4 weeks. With the more lock products, we're seeing that take a little bit longer. Competitive rates, especially when we're comparing it to private money, hard money. If we're talking about 0% credit cards or prime plus one at 4.25%, it's very cheap money to be able to go use on our deals right now. Easy to use, write a check. We're going to show you 3 to 5 different strategies to be able to use the credit cards. Very quick, easy, and it's not dependent upon a deal. So you don't have to have a property under contract. You don't have to be getting into a specific deal to be able to acquire a line of credit. You want to acquire it whenever you're in the best position credit-wise to be able to do so that you don't miss out on that next opportunity. Cons. Banks' underwriting procedures may change over time. We're starting to see that a little bit now with banks tightening up with COVID. So that's one of the things that tends to get tricky over the course of time, is just managing the changes with banks. UCC filings. Like I mentioned before, UCC filings will be dependent on the bank. If a UCC filing is put on one of your lines of credit, it does sort of halt all the lines of credit after that you can acquire. That's why working with somebody like us who knows which lenders are going to put a UCC filing on your line of credit does matter, because that allows us to acquire multiple before going to a lender who's going to kind of halt any other funding that you're able to get. As a real estate investor, you may only qualify for lines up to 100K each. Like I mentioned, that's more of that streamlined line of credit product where it's going to be somewhere between 25 to 100K. You may be a fix and flip investor who's doing a lot of deals and have really good revenue, who would want a traditional line of credit at 10-15% of your revenue because you're doing good revenue. But as a real estate investor, banks tend to shy away from you because you're considered high risk. So as a real estate investor, you may only qualify up to $100,000 on each line of credit. But again, that's where we'll get strategic in being able to acquire more than just one. So, even though you're just getting one line of credit at 100K, if I can get you 4 lines of credit at 100K, it's still access to $400,000. Short-term use, not meant for long-term debt structuring products. And what we mean by that is, if you're going to get into a turnkey rental, you don't really want to use your line of credit knowing that it's going to be years before you build up enough equity to refinance and take cash back out. So, it's all about the exit strategy. Short-term use on a fix and flip, and then short-term use on a buy and hold, especially if you're doing the BRRRR model. If in 6 to 9 months you're going to be able to refinance, pull all the cash back out, pay your line of credit back down to zero, it's a great product. But if you're getting into more turnkey rentals where you need to have that 20% down payment and it's going to be a couple of years before you can pull equity out, it's not the best idea to pull off the line of credit. That's just a little bit of advice and guidance on our end. Variable rates based on prime. So yeah, technically it's a variable rate. Prime is a variable rate, but all lines of credit are tied to prime. So if you're approved at, say, prime plus one, the one thing is you'll always be approved at that plus one number. Prime may float. So a couple of weeks ago, prime was actually at 5.25. So if you were approved at prime plus one, a couple months back, you were paying 6.25 interest-only payments on the usage of your funds. Over the past couple of weeks, your interest rate's actually been lowered to 4.25. So prime will float, and that will affect the interest rate on your line of credit. So that's it could be looked at as a comp. Underwriting is normally 2 to 4 weeks. So that's why we always say you want to obtain the line of credits before you have a deal and actually need to use them, because it's a little bit more time consuming than just going to the hard money lender or going to private money. We want to make sure that we have enough time to implement the line of credit so that you can use it on the next opportunity. Higher interest rate than a mortgage rate. And that kind of ties back into how you're using it for your exit strategy on your deals. We don't want to be carrying this, carrying a couple $100,000, at a higher interest rate than we could if we can just refinance it or put it into a conventional mortgage. So we want to make sure that we're using the right tools in our toolbox for the right reasons. Just a little bit more about MB Capital, who we work with. Business owners in general, Business owners who need working capital, they have payroll, they're bringing on new employees, they need to front cost. They may be expanding a business, buying a building, or a business owner who just needs emergency reserve funds. And then I would say about 90% of our clients are real estate investors. So real estate investors looking for gap funding, funds to scale their business and do more transactions, to either self-fund deals and make them more profitable, kind of cut out hard money, cut out the private money lender, and leverage a line of credit is going to make your deal more profitable. We work with a lot of real estate coaches coast to coast. So a lot of the big educational companies will send us their students, not only to help them get funds to kind of reposition tuition debt, but then to also, be able to get out there and do a deal. And that's why, me, my partner, most of the advisors on our team are all real estate investors. So that's our real niche market, and being able to help the real estate investor get access to funds and, really not miss out on any deals. So I know we had a couple questions. I saw a couple come in through YouTube and Facebook. What I'm going to do now is just kind of go through a couple of those, and just any other questions, please, don't hesitate to shoot them at me here. We're going to spend the next couple of minutes just asking a couple questions, and we'll kind of go from there. So the first question was, assuming my numbers look good, would I qualify for an unsecured line if my rentals are deeded in my name instead of an LLC? Great question. Yes, you can qualify. If your personal credit's in good position, you have an entity that's set up, you can definitely get access to funds, even with rentals in your personal name versus your LLC. My suggestion there is, at some point, you want to be able to, start to push everything into the LLC name so that it's not impacting your personal credit. But as current things are moving, even if you have multiple rental properties deeded in your personal name and they're shown up on your personal credit report, we don't care as much about debt to income ratio as we do about credit score, overall utilization and those data points that I mentioned. So, as long as personal credit looks good and data looks good, I'm not concerned about debt to income ratio. So those rental properties wouldn't get in the way of us being able to acquire an unsecured line for you. Here's a question. It's a good question. Can we use these funds as seasoning funds? So, we've had a lot of clients recently come to us and say, yeah, now my hard money lender needs, funds to be seasoned. Yes, you can take the funds off of the line of credit cards, put it into a bank account, use it to show a hard money lender that you have cash seasoned. Now would be the time to start to make those maneuvers, start to get cash into a bank account off of the line of credit, off of the credit cards, so that, depending on who you're working with in terms of hard money, they're able to see that it's been in the bank account for a long enough time to be able to close on your deal. That looks like all the questions that we have. Hi, Eric, waving right back at you. Appreciate that. We'll put that up on screen. Hello. So before we jump off here, I just want to tell everybody, again, thank you for joining me tonight. Now with everything going on, definitely start to position yourself. Moving forward, there's going to be a ton of opportunity. So, you've run into a problem with one of your deals or with a lender, definitely reach out. We have a lot of good solutions where we may be able to help. I've had clients where, they were getting a draw from a hard money lender, and because the hard money lender now required 6 months of reserves, took 20 grand out of his draw. So he had to scramble and get access to more funds to be able to complete his project. Lots of those types of stories are coming out. So if you have issues, if you have, anything going on where we might be able to help, our contact information is below. Please don't hesitate to reach out. In the comments, I'm also posting a link. The link is to our page, MB Capital's page. If you go to that page, you'll be able to actually see a quick explainer video of a little bit more in depth about what we do, but then also, give your information and get set up with a time for us to have a funding consultation with you directly. So, I just posted in the comments, follow that link. It'll give you a little bit more information on us, on how to get scheduled with the time for us to be able to see how we can help you. I hope everybody is out there staying safe, staying happy, staying healthy. Hopefully here we're back out into society again, and we're moving towards getting back to normal, whatever normal that may look like. Any way that MB Capital can help, that I can help, that my partner and our team can help, please reach out to us. I look forward to having conversations with anybody who may be watching this, whether you're watching it live or on a replay. So anything we can do, make sure that you're reaching out to us. Again, thank you for spending your Thursday night with me for 45 minutes. And I look forward to a future conversation. Thanks, everybody.